as an introduction, so few words about the PPF group and the home credit. So actually the PPF group is a relatively large group. It's the largest, I think, in the Czech Republic. And the part of this group is also the financial division, which is the home credit group, operating in many countries, especially in Asia part, like a huge operation in China, Vietnam, Philippines, but also in the Czech Republic, having the three companies in the financial services, Slovakia, and over like Central Europe, including the Russia, where we have also the banking license. So about the optimization from my personal practice, I'm always saying that if you implement the optimization, you can't lose anything, because I already made several projects in my last 8 years, and I never saw that we would make a benefit lower than a 10% profit uplift. Actually, it was always significantly more, like 20% plus, even with the first optimization which we did in like 2012. We had like 26% profit improvement, although that from the beginning we were not able to use some data and some models were not perfect, etc. Still, the optimization give us a significant profit uplift. So the good on optimization is that usually if you want to improve your profit more significantly, you have to do some big projects, some big innovations. What is interesting on optimization that in most of the banks, in fact, in all my previous implementations, we didn't need any IT projects, because you make your analysis, as Mark was describing, you make your simulations, you finally end up with some final strategy, which can be then implemented to the normal decision engine. And you don't even need to have the FICO decision engine. You can implement it to whatever decision engine. So you do like a standalone your analytic work, then you transfer it to some structure which is acceptable for the decision engine, and you can easily run it. So you made a relatively big uplift, big benefit, without big IT planning, without big projects. What I like on optimization is that you have one strategy with one clear structure, and you get rid of many overlapping rules which were implemented in many last years. And from my practice, there are always many people who coming implementing something, then they leave, the new comes, they implementing something, and then everyone try to fine tune it somehow without understanding the overall structure. So the most of the banks where we did the optimization, in fact, we released all these legacy rules, which finally nobody fully understood how it influenced the overall result. And you implement the one structure where you have the policy rules, plus you have your full pricing structure, which puts you to much better position in ability to manage the business. Because if you want to change something, you go to the optimizer, you change it, you implement the new tree to the decision engine, and it's done. So you don't have to do some additional overlapping things in your decision engines. Optimization is not the one-off thing. It's an approach which you can expand in many different areas. So, for example, when I was leaving the previous bank, we were launching the collection optimization. We did it in a credit card limits. You can do it in a pricing, which is about the decision, but you can do it also in optimizing your DTI ratios, deposits rates, so whatever. So it's a new approach. If you do the first project, the people will understand it. And what I saw in my practice, the people start to like it, and they were expanding this approach in different areas, because every area which we touch with optimization, we realized the significant benefit. With the optimization, there is also some, I would say, side effects, but these side effects are, from me as a CRO of the bank, very important, because the first one is that the optimization brings the discipline. In the past, I saw the cases where we calculated that this segment has the best profitability. We charge them 15%, then someone else come that it's the best 18%, then another one comes with a 17%. And all three people had their own calculation that their result makes sense. For me, from the management perspective, it was very difficult to understand which of the calculation is correct. And very often, I guess you know it from your practice, that the people are coming with the calculations with always proving what they want to achieve or what they want to implement. But in optimization, you can't play too much with some own assumption that you believe that something happens, but actually, in many cases, it doesn't happen. The optimization make you the data-driven simulation, so you see the results without any personal assumptions, which finally bring the discipline in that sense that if you want to do some change or some management decision, okay, fine, we made a simulation, we see the impact on a profit, and we make the management decision. So it's then very easy and straightforward to do, because, for example, the sales came and said we have to sell more. We want to decrease the interest rate. We said, fine, let's do it. So we just calculated that we will lose like 10% of our profit, and we have to do the management decision. I'm not saying that it's bad to make more volume for and lose 10% of the profit, but the decision is then clear, it's logic, and we can take even such a decision. But it's visible on the numbers, and then nobody is surprised and nobody is pointing each other that it didn't deliver what we expected. It also allows you to have more precise planning, modeling, because you know very well what happens if you change something. It is the same with the stress testing. You can add to the optimization some of your expectation as a stress test, and it gives you the result. So, for example, when we discussed during the COVID crisis that the over risk on a market, which means within our risk grades, will increase of something, where we should place the cutoff, because we made some coefficients for the general increase of the risk within the ratings. And then we made the respective scenarios. What happens if it increase of 10%, 20, 30, 50%? And then we can see the impact to our clients which are close to the cutoff, and we can make a decision. So we said, for example, okay, we do expect that more or less it will be like a 20-30% risk increase. So we move the cutoff based on this assumption from the stress test which we expected. From the working perspective, in our optimization, where we made like a metrics, risk, and the business, it also bring the better cooperation, because as you probably also know from your experience, very often the risk and the business can have a different opinion on some differences. So the risk is saying, if I will relax the limit in these like ratings, it will increase my risk. And the sales is saying, not, but we believe that it will not be as big impact. But if you have an optimization and you have everything inside set up correctly, you know the result. So you are not focused on your calculation and convincing the opposite part, but you work together with the models, and the optimization gives you the best possible result. You can still do the management decision that you will sacrifice some part of the profit for the better market position, which is like normal, but it is a management decision. It is not that one or second part has a true. The people tend to more cooperate on respective models inside the optimization, because the optimizer is that engine which has a true, not the risk or not the sales or not the CRM guys. The optimizer has a true. So there is no need to challenge each other. All the discussion is much more data driven. So you see the results, you see the most efficient frontier, you see the results of the respective parts of the process, like take up rate, what is the structure of your interest rates. So the whole discussion is more about how the model works, whether we could something improve, and it's much more data driven. And as I mentioned previously, this what happens if you can run very well the simulations. So if you decide to run the actions like a fixed price for everyone, you just change the parameter, you made the simulation, and you see the comparison. So whatever changes you would like to do, you can simulate it very easily and know the full impact. And the simulation quality from the optimizer is much more precise because of this action effect, which is compared to the traditional approach. We tend to, for example, we decrease the price, but we don't look what does it means for the credit risk too much. In optimizer, if you decide to decrease your price because you want to improve your market position, you immediately see the impact to the risk cost. In fact, the optimizer reset up your credit policy the proper way, including the risk. So this impacts to every single different parameter is very important, and you will not be able to do it in Excel because it's simple from the scale of the managed problem impossible.